This video begins a two-part section on the topic of IFRS 10, Consolidated Financial Statements, a standard which lays down the principles for consolidating businesses that are controlled by the reporting entity, namely its subsidiaries. The basic premise of IFRS 10 is that a company which controls one or more other entities is required to present consolidated financial statements. The entity which exercises control over other businesses is naturally the parent, whereas the companies over which control is exercised are its subsidiaries. Although the parent and its subsidiaries remain legally separate, the consolidated financial statements of the group which they constitute must be presented as if those entities were in fact a single business. This perspective on reporting the activities of a group is referred to as the single economic unit concept. The group financial statements will therefore include the assets, liabilities, income and expenses of the parent and its subsidiaries, but will not, for example, show intra-group balances such as amounts owed by a subsidiary to its parent or the profits generated on transactions carried out between group members. This method of preparing consolidated financial statements involves replacing the cost of the parent's investment in subsidiaries with the individual assets and liabilities of those subsidiaries, which, when combined with the assets and liabilities of the parent, provide an indication of the resources and obligations of the group as a whole. One of the key features of IFRS 10 is that it establishes the rules for assessing whether the relationship between one entity and another may in fact be deemed to constitute control. IFRS 10 states that an investor controls an investee if it is exposed or has rights to variable returns from its involvement with the investee, and has the ability to affect those returns through its power over the investee. Accordingly, an investor is deemed to exercise control over an investee if and only if that investor has all of the following: power over the investee, exposure or rights to variable returns from its involvement with the investee, and the ability to use its power over the investee to affect the amount of the investor's returns. We will now examine these considerations one by one. The first criterion relates to power. An investor has power when it has existing rights that give it the current ability to direct the relevant activities of the investee. IFRS 10 defines relevant activities as those activities of the investee that significantly affect the investee's returns. Examples of relevant activities may include the selling and purchasing of goods or services, determining or changing the company's operating and financing policies, researching and developing new products or processes, appointing, remunerating or terminating the employment of an investee's service providers or key management personnel, selecting, acquiring or disposing of assets, determining a funding structure or obtaining funding. The rights which give the investor the ability to direct such activities typically include voting rights, potential voting rights which arise from options over shares or instruments that are convertible into shares, or the rights to appoint key management personnel. The second criterion for assessing whether an investor exercises control over an investee concerns whether the investor has an exposure or has rights to variable returns from its involvement with the investee. Such conditions are deemed to exist when the investor's returns have the potential to vary as a result of the investee's performance. A principal example of variable returns from an investment are, of course, dividends. The third and final criterion for assessing the existence of control concerns the investor's ability to use its power over the investee to affect the amount of returns that it generates from its involvement with the investee. IFRS 10 states that an investor who has power over an investee but cannot benefit from that power does not exercise control. Similarly, an investor who has an exposure to variable returns from its involvement with the investee but cannot use its power to direct the activities that affect the investee's returns also cannot claim to control the investee. Once the existence of control is established, IFRS 10 requires a parent to prepare consolidated financial statements using uniform accounting policies for similar transactions and events. If a member of the group uses accounting policies which differ from those adopted for the purposes of preparing consolidated financial statements, appropriate adjustments are required to ensure conformity with the policies followed by the group. Preparing consolidated financial statements naturally involves combining like items of assets, liabilities, equity, expenses, and cash flows of the parent with those of its subsidiaries and making relevant adjustments to these figures. A potential problem arises when the individual financial statements of the parent and its subsidiaries, which are used in the preparation of the consolidated financial statements, are in fact prepared as at different reporting dates. IFRS 10 states that if the end of the reporting period of the parent is different from that of a subsidiary, the subsidiary must prepare, for consolidation purposes, additional financial information as of the same date as the financial statements of the parent, unless it is impracticable to do so. In the event that the subsidiary is unable to prepare such additional information, the parent must use the most recent financial statements which have been prepared by the subsidiary. These must be adjusted to reflect the effects of significant transactions or events that occurred between the subsidiary's reporting date and the date of the consolidated financial statements. However, the difference between these dates cannot exceed 3 months.